Hello and welcome to another live technical analysis. When we're starting off with the euro against the US dollar, currently appears to be moving in an upwards fashion, continuing to validate our upward moving trend line. Now, what might be interesting is the RSI indicator below our chart, which currently registers the figure of 56, thus implying slightly neutral market sentiment. However, if you look at the big picture, which is the upward moving trend line and the Bollinger Bands appearing to be tilted towards the upside, it could also imply that this is a small market correction before the pair continues on its ascent. In terms of financial releases, we would be noting the US CPI rates, which are due to be released later on today. Now, the headline CPI rate is expected to accelerate on a month on month level to 0.4% from 0.3. Instead, the year on year level expected to stay the same at around 3.1%. Now, should the CPI rate, the headline, on a month on month level accelerate, that could provide some support for the greenback, which in turn could weigh on the euro. Now, why could that provide support for the greenback? Well, if inflationary pressures are appearing to persist in the US economy, then that might opt for the Fed to adopt perhaps a more hawkish stance, implying higher rates for longer. Furthermore, considering that we are now in the Fed's blackout period, which is 2 weeks before their interest rate decision, we will not see any Fed speakers. So, following the release, we won't see perhaps comments from Fed Chair Powell, Fed Master, etc., etc. So, the market reaction could predominantly guide the pair's direction. As such, as a recap, inflation pressures persisting in the US economy could provide support for the greenback, thus weighing, which could result in a short for the pair, whereas lower than expected could allow the Fed to adopt a more dovish tone. Now, we expect the release of the CPI rates to be perhaps mentioned in the Fed's accompanying statement in terms of the tone that they might adopt following their decision. For now, I would maintain a bullish outlook given that it's continuing to validate our upward moving trend line and that it's resting on the mid range of the Bollinger Bands, which are tilted towards the upside. As such, for our bullish outlook to continue, it would require a clear break above R1, 1.0982. Next target potentially being for the bulls at 1.1040. Whereas for a bearish outlook, simply breaking below S1, 1.0890 would be sufficient for a switch towards a bearish outlook. Now we're moving on to the dollar against the Japanese yen, which might be interesting considering the recent news coverage it's been receiving. Now, in terms of recent news coverage, we're of course referring to the comments made by BOJ Governor Ueda, essentially implying that once the bank reaches stable and persistent 2% inflation, so CPI, which is the bank's target, we may see an abandonment of the Bank of Japan's ultra loose monetary policy that has been in place since 2007. Now, if you're watching Bloomberg, they are attributing a 50-50% chance for a hike either to occur in March or in April. According to JPY-OS, the high probability is for an April rate hike, whereas for March, it's about 52% and 48. So 52 for a hold, 48 for a hike. So it's a bit 50-50 as Bloomberg had reported. For now, we're seeing the dollar strengthening against the JPY, which is a bit interesting. It's a divergence from the comments because if you're expecting the BOJ to abandon its ultra loose monetary policy, so the last hike was in 2007. So if they're going to hike, it could potentially provide support for the JPY. We would have expected the pair to move in a downwards fashion. Now, this may have been a downwards moving trend line, a relatively steep one, I'd say, but nonetheless, you had two occasions where it touched, so validating it. Having broken above, I'd actually bring my S1 at 146.50. So that would be my S1. Let's see. So this is for S1. S2, we could keep it at 144.35. Although personally, I like to bring it slightly higher. So I'm trying to find the most recent price action, which has had the most movement. So we could take this swing low, for example. You can see it touched, broke above, came back down, found resistance, found support, turned to resistance, broke above, validated on one occasion, the second occasion, fourth, third, fifth by the opening of this candle, despite it moving down, sixth, and then a seventh. As such, giving more weight to 144.80 since we're rounding it up as a potential S2 support level. Now let's readjust 144.80 0.80, and that's my S2. S3, we could keep it at 142.80 since we're using this from a more macro perspective, potentially being validated for today and tomorrow. In terms of resistance, 147.75, recent price action. Now, with the pair having broken above the mid range of the Bollinger Bands, the RSI being at 42, and then the breaking of our downwards moving trend line, we would maintain a sideways bias for this particular pair, staying between S1 and R1. Now, if it manages to break below S1, we would switch for a bearish outlook, breaks above R1, bullish. However, based on the comments made by BOJ Governor Reda, I would not be surprised if more BOJ policymakers imply a potential rate hike is coming soon and as such could provide support for the JPY from a more macro perspective. As such, I would be bearish for the pair, given that it is the dollar against the JPY. Such, I would like to see a break below S1. Next target potentially being S2. Now, for the British pound, if I'm not mistaken, Morgan Stanley had said that the markets are pricing in a much lower expectation of a cut by the BOE. In terms of the pair, now the employment data for the UK was released earlier on today. Sudden tick in unemployment could be weighing on the cable. Such, note how it's testing S1, 1.2775, RSI at 50, so implies a neutral market sentiment. Yet, with the employment data and the apparent movement, I would not be surprised if it breaks below S1, takes aim for S2 at 1.2700. Lastly, we have S3 at 1.2615. But for a bearish outlook to occur, it would have to break below S1. If it does not break below S1, I would maintain a sideways bias between S1 and R1. Once again, this particular pair could be impacted by the release of the US CPI rates later on today. Whereas CPI rates implying persistent inflation pressures, we may see the dollar gaining. As such, breaking below S1, taking aim for S2, if not reaching S3 as well. We're going to be looking at oil. Now, we haven't really seen oil, and I'm going to be bringing R1 at this most recent high. So note how the price action on two occasions came back up, failed, came back down, and then came back up again for another try before moving lower. As such, this would be a valid resistance level for me at R1. And let's see if we can round it up down to 0.5. Appears to be valid as well. So we're bringing old R3 lower. Now, the issue with oil is that the initial geopolitical shocks from the conflicts in the Middle East appear to have gone through. We're noting the API crude oil inventories and the EIA weekly crude oil inventories. API for today, EIA for tomorrow. Now, what was interesting was in the past week, it implies that there is demand is exceeding supply. That supply is exceeding demand, which may have weighed on oil prices. Now, in terms of technical analysis, however, we can bring S1 higher. You have a bearish and a bullish candle, closing and opening at the same level. So support, it's also coinciding with a nice figure, 76.85. Now, the reason as to why we like to round it up is the psychological impact. We believe that, and it appears to be the case, that if you're placing support and resistance levels, perhaps most people could opt for a big figure. Why place at 26.83, just round it up to 0.85. Such why we round it up as well. In terms of S2, S3 at 71.55 is far, far away from the price action. Note where R2 is and note where R3 is. So let's say we didn't have this line here. You can see there's a clear gap between S1 and hypothetical S2, which doesn't really make sense. I'd rather opt to place another support level in between S1 and S3 for a clearer picture in the event that it does break below S1. So what I'd like and what I'm seeing here in terms of, let's just move this here. Now, in terms of price action, I'm looking at this here. Heavy support, moved higher, came back down, broke below, moved lower, broke back above, moved higher. 74.20 would be my S2 level. Let's just turn this to green as well. 4.20. So that says 2. Now we're going to be looking at Boeing later on during this live technical analysis. Why Boeing is very interesting. You have continuous news coverage, which is pretty bad for the company, and I'll be explaining why in a few moments. For now, narrowing of the Bollinger Bands, you have RSI at 52, so neutral market sentiment, CCI appears to be within the range, all implying for a sideways bias for WTI between S1 and R1. Now, in terms of geopolitics, if we see an escalation between Venezuela and Guyana, that could, of course, potentially increase the oil price as uncertainty over the supply of oil might increase. For now, that does not appear to be the case, but once again, is worth keeping an eye on. Let's move this old line. So as you can see, relatively sideways fashion between S1 and R1. Moving on to gold. Now, gold is a very interesting story. You could attribute either to technicals or geopolitics. You have high uncertainty in the markets. If I'm not mistaken, the CEO of JP Morgan, Jamie Dimon, implied that the risk of recession has not faded away, which could be a fundamental reason why gold might be moving higher. You could also attribute gold strength to the weakening of the dollar. All in all, appears to be optimistic for gold against the US dollar. Having formed new all time highs recently, appears to be bouncing off resistance at 2,183. So that would be our resistance level. And why is that our resistance level and not the all time high? Simply put, we're on the daily chart. Look at the closing of this bullish candle, and then look at the wick of this bearish candle. It implies that there is selling pressure at that particular level. So let's zoom out. Let's readjust our R1 level, 2183 for R1. The with all-time high figures, and we don't have any price action in history for the current price of gold. I'm not going to be rounding it up. I'm going to be keeping it at the point that it is. I think that's a bit more accurate. Whereas had I had prior price action, perhaps we could have rounded up. For now, you have R2, hypothetical R2 and R3, 2,230, and then R3, 2,280. For S1, we're taking the previous all-time high figure of 2,136. Further than that, 2,090. And then you've got S3 at 2,052. Now, let's look at the indicators. The Bollinger Bands have widened extremely. So you can see lower bound, mid-range, and upper bound. So high volatility in the market. RSI at 81 implies a bullish market sentiment, yet is in overbought territory. So I would not be surprised if it comes back lower. This could be a swing high. Price action drops back down to S1, gathers orders, and moves in an upwards fashion. So a small market correction to S1 may be due, given that it is overbought, and you can see that it's slightly turning. So the bullish momentum may be fading away, at least temporarily. So we would maintain a long-term bullish outlook on the price of gold, but perhaps for the next few days, we might see a small market correction down to S1 before it continues on its ascent. And once again, keeping an eye out in geopolitics, which could funnel safe haven inflows into gold. Gold could also be affected by the release of the CPI rates later on today. Now, looking at the Canadian dollar, we had this box form. Let's remove this. Tested S1, 1.3435. Mid-range of the Bollinger Bands. Broke above, corrected higher. Might be a bearish signal as well. RSI 41. For our bearish outlook to continue, I would like it to break below S1. Now, in terms of resistance, we could drop R3, make it R1. So this R2 and this R3. R1, 1.3505. Control C. New R1, current price action. Would maintain a bearish outlook. Came back to the mid-range. Is now below. So bearish outlook for the particular pair, which means that the loonie is strengthening. Note that we've noted a small divergence between the price of oil and the loonies strengthening. So oil prices were moving slightly lower last week, yet the loonie was gaining. So that divergence could continue, which is worth noting. For now, from a technical point of view, market correction would be bearish for the particular pair as long as it breaks below S1 at 1.3435. Moving on to the Aussie, note how it bounced off S1 is 0.6595. Now we might see, now for this pair, I'd maintain a sideways bias. And why is this different than the other ones? Well, narrowing of the Bollinger Bands, smoothing of the 50 and 100 moving averages, RSI near 50. It's at 60, so it implies some bullish tendencies may persist in the pair. But overall, it came back down, narrowing, staying in between at the mid range of the Bollinger Bands, smoothing out of the moving averages. If RSI drops to 50, could all imply for a sideways bias between S1 and R1. If it breaks above R1, bullish, breaks below S1, bearish. You can see the targets for the bulls at R2 and for the bears at S2. Further than that, you have R3 and then S3. When we're looking at the Nasdaq, S&P 500, and Dow Jones 30. But first of all, I would like to go to Boeing. Boeing, if you've been following along on our live technical analysis sessions, we've been bearish since, I'd say, right around here, the 12th of January. Now, in order to explain Boeing's fall from grace, you have to go back to the Alaska Airlines incident, where a door plug was not properly installed, blew off, and then the plane had to divert, causing a ruckus amongst the FAA, which is now investigating Boeing #BA for their practices, so their manufacturing practices. Now, even at here in our lives, we were bearish. Why? Well, if you have an issue with one plane, logic dictates that it's not the only one, and that appears to be the case. In terms of new developments, we're noting that a grand jury has been convened in the criminal investigation against Boeing, according to various media outlets. I'm also switching R2 and R3. Now, we had two issues with two of their planes. If I'm not mistaken, they had to redivert. One was from Sydney to Auckland, which had to redivert for technical issues. And then we had another one which rediverted to Amsterdam Airport as well for technical issues as well. Different model planes, but both had technical issues. Now, we should state that they have not been attributed or blamed on Boeing as of yet, but I would not be surprised if the negative news coverage on Boeing weighs on the company's stock price and moves lower. From a technical point of view, it had broken as one that was valid since the beginning of January. Has broken below. Target for the bears might be 176.6, but we'll have a look at that in just a moment. Before we place the remainder of our support levels, technicals, widening of the Bollinger Bands, market volatility appears to be increasing. RSI at 30 implies a strong bearish market sentiment, and as the criminal court case proceedings continue with perhaps subpoenas, investigations, etc., it could all weigh on the company's stock price. We see more issues with the planes, and if you simply Google Boeing, I think you will see what I'm talking about. We had an issue with one of their planes. A wheel blew off last week for a United Airlines flight. Essentially, the news coverage is awful, to say the least, which could continue weighing on the company's stock price, which I think is logical. Nonetheless, you have technicals. RSI 13 breaking below S1, bearish outlook. First target could be 188.20, fairly close to S2, and as such, for our bearish outlook to continue, it would not have to break only below S1. We would require a clear break below S2 as well at 176.60. Lower than that, we have 158.35 potential target for the bears. In terms of the bulls, if it breaks above R1, I would not be convinced of a bullish outlook. I perceive that as potential as a market correction or staying sideways between R1 and R2. For a bullish outlook, it would have to break above R2, but at this point in time, I don't see such a scenario based on the fundamentals and from a technical point of view. Now, we are also going to be moving on to Airbus. Airbus could potentially capitalize. Now, one may be wondering why Airbus isn't soaring higher. Well, they have a backlog of orders, which means their production capacity may be at their limits. Thus, might be slightly concerning. Well, not concerning, may have not allowed the company stock price to gain as much as one may have thought. Now, on to one of my favorite stocks, being ExxonMobil, which I like looking at during my live technical analysis. You can see it's broken above R1, moved higher, and is now testing R2. So we had R1 properly placed and R2 properly placed, which is now R1. We would maintain a bullish outlook for the company's stock price from a technical point of view. Simply note the RSI underneath our chart, which registers the figure of 71, implying a strong bullish market sentiment. Furthermore, one could draw an upwards moving trend line from this point, so this bullish candle validated on 3 occasions and continues to be validated. So, all in all, bullish outlook for the company's stock price. Since we've been correct with R1 and R2, we're keeping R3, which is now R2, and we will be looking for resistance at R3. Usually, I like to take previous highs, which may be interesting. Why? If a previous high, you may have had sell orders, so pressure, as we saw on R1, broke above. Now seeing at R2, which has turned to R1. In terms of R3, might be an interesting dilemma. If I place at the high, might be too far away from R2. Whereas here, we could see some selling pressure from individuals that may have gone short at this point. Came back up, took anyone that had a stop loss here, perhaps moved lower. R2, R3, 118.30. If we round it up, 113.40. So that would be my R3 for ExxonMobil. Now, there is a fundamental issue for ExxonMobil, and that's not the technicals, that's not the financials, it's geopolitical risk. ExxonMobil has a heavy investment in Guyana, which has been subject to claims by Venezuela, approximately two-thirds of the Essequibo territory. Now, in the event that that does escalate, it could weigh on ExxonMobil's stock price. For now, that does not appear to be the case, and as such, we would maintain a bullish outlook for the company's stock price as long as it manages to break above R1. If it does not break above R1, we would switch for a sideways bias. We wouldn't be bearish. For a bearish outlook to curve, it would have to break below S1. Why? It could be a market correction to the trend line and the mid range of the Bollinger Bands, which is why we would not switch for a bearish outlook if it does not break above R1. Instead, sideways bias between S1 and R1, bearish only if it breaks below resistance turn support at 104.78. For now, we're also noting potential R3 at 118.40, which we noted together. So this is potential resistance at R3. Have S1, S2, and S3, removing old support at $89. Upwards movement bullish for ExxonMobil. Now let's look at the indexes. So the Dow Jones 30. Now, before we go into the technicals, let's simply look at the indexes. So the Dow Jones 30, so the industrial average, S&P 500, and then the Nasdaq. Now, the S&P shows signals of it going upwards. It's validating this upwards moving trend line since the 19th of October in 2023. Whereas if you look at the Dow Jones 30, there appears to be some resistance. Compare the Bollinger Bands in the S&P 500 and the Dow Jones 30. I think you're seeing what I'm seeing, which is straightening out, a smoothening, potentially finding heavy resistance. Whereas S&P 500 is bullish, tilted towards the upside. Bollinger Bands, RSI, the Nasdaq, similar issue, similar look to the S&P, but appears to be struggling slightly. Nvidia, note R1, which is now actually S1, broken above, break down. So this is actually support. The issues or the slight bearish tendencies perhaps in the Nasdaq could be attributed to Nvidia. Nvidia appears to be carrying the index on its back. Nonetheless, let's look at the technicals, starting off with the Dow Jones 30. Support and resistance. We're keeping them the same. 38K for S1, 37.1K for S2, 36,290 for S3, R1 39K, R2 40K, R3 41K. Now, RSI is at 54. Note how it's been gradually moving lower and lower and lower, which means that the bulls may be ceding control or the bullish momentum may be waning. As such, sideways bias between S1 and R1. If it breaks above R1, forms a new high higher than this wick of this bullish candle, we could maintain and switch towards a bullish outlook. Whereas if it breaks below S1, we would switch for a bearish outlook. There is a sign the narrowing of the Bollinger Bands, however, imply a sideways bias for the index, at least for now. Could also be dictated by the release of these US CPI rates later on today. Now, the S&P 500, I would be maintaining a bullish outlook. The tilted Bollinger Bands towards the upside, the validating of support at 5,100, RSI at 64, so implying a bullish market sentiment, so consistent at near 70, implies that the bulls may still be in control. Now, for a bullish outlook to continue, continues to validate this upwards moving trend line from here up until here. So bearish candle, bearish candle, etc., etc. But it would have to break above R1. If it does not and it breaks below the upwards moving trend line and it stays between S1 and R1, we would switch for a sideways bias. For a bearish outlook, simply breaking below S1 would be sufficient as it would coincide with a breaking below our upwards moving trend line. In terms of the Nasdaq, now for the Nasdaq, I wouldn't be that bullish. The RSI is slightly different. So let's just have a look. 54, 64, and 56. Now, it appears that the S&P 500 is moving upwards. The Dow Jones 30 is moving relatively sideways. And then the Nasdaq 100 is facing some heavy resistance. So two tops, not a double top, but it faced resistance at this point. So we could actually bring R1 to this wick at 84K 424 425. So let's just readjust, and then we can just keep R2 and R3 just in case we're wrong. So it breaks up higher and moves towards R2. Now I'm actually going to zoom in. So this is the daily chart. Let's look at the 4 hour. 4 hour might provide some more clarity into what's going on currently. Just removing this old text labels and fixing my S3 one. So we have S3. Now, if we look at the 4 hour, relatively sideways between S1 and R1, came back down, but the trend line was run on a daily, so that's not an issue. Relatively sideways, that's okay. Higher high, higher lows. Bit concerning here, however. This was slightly higher. Higher highs and higher lows would have been fine, but a bit of a concern. So, what does that mean? Well, once again, we have to wait for the release of the US CPI rates. And why? Well, it could impact or influence the Fed's interest rate decision, which in turn could be reflected in the US stock markets. From a technical point of view and ignoring the financial release, it's resting on S1. So for a bearish outlook, simply breaking below S1 would not be sufficient. Could be a market correction. It could be temporary before it moves higher. For a bearish outlook, it would have to break below S1 and move towards S2. Either wicking down or closing on S2 would constitute for me as a switch towards a bearish outlook. For now, based on the fact that it's validating the upward moving trend line, we could be slightly bullish, yet we note our concerns for it staying between S1 and R1 should it fail to break below R1. And when we say fail to break above R1, if it wicks up, doesn't break above or doesn't close above, sideways bias between S1 and R1. Fairly narrow, granted, but still sideways between S1 and R1 if it does not break above R1. If it does break above R1, next target could be 19,600, and we could revisit it in tomorrow's live technical analysis, where we'll be assessing and seeing the impact of the US CPI rates that are going to be released later on today. Now, what might be interesting for you at home could also be NVIDIA. High volatility. Now, in terms of S1, of course, that's my S1. S2, 746.10. Why am I keeping this as S2? Note this bullish candle. Note the price action. Came up, found resistance. Came down, earnings, jumped, wick down, validating this as resistance turned to support, moved higher, slightly jumped, wicked, validating this as support, resistance, and on 55 we could keep it the same. Now, what might be interesting is the RSI. It's still at 65, so it was perhaps overbought, corrected lower, might rest on this one before moving higher. So could be a temporary market correction to lower ground. 746.10 becomes S2, S3 becomes 629.90, and then target R1 955. That's my R1, R2 1070. And then for R3, we will be calculating the distance between the hypothetical resistance level of R2 and R1, and then simply reflecting it higher. So distance between R1 and R2, 113.76, 113.76, 1,200 is more than enough. Big figure as well. Psychological impact. And that becomes hypothetical resistance at R3. Crazy to think how high NVIDIA has gone within a relatively short time period. Nonetheless, R3, 1,200 as we have noted. Hypothetical resistance, we'll have to see if this is validated or confirmed, as we are talking about all-time highs. For now, if it stays above S1 at 833.70, we would still maintain a bullish outlook for the company stock price. If it breaks below, switch bearish outlook, taking aim for 746.10. Other than that, you have 629.90. So we've done Nvidia, we've done Boeing. We could do Netflix, Apple, Tesla, and unless there's something in particular you would like us to see together. Tesla, sideways bias actually between S1 and R1, because we've been looking at this for S1. Our side 36 so implies there are some bearish tendencies. We'll have to see. Overall, sideways bias. So we've done gold, oil, Aussie, CAD, cable, euro, JPY. What else can we have a look at? See Disney. Okay. Airbnb, Coca-Cola, sideways, Google. Okay. And then Bank of America. We could look at Ferrari as well. Ferrari. Given that the Grand Prix, F1 is back, so might be an interesting overall to see. So this was R1, now turned to support, 409. RSI 51, I'd say from first glance sideways between S1 and R1. So S1, S2 390.30, then S3 371.10, and we're going to be moving our old support level. And then we have R1 428.0, R2 448.0, and then for R3, same thing as before. We measured the distance between R1 and R2 and simply reflected higher. Note that we are on the 4-hour chart. For gold, we were on the daily. I'm not mistaken, 1894, 2100 should be okay. 468. Let's just round it up. 468. 468.00. Control A, Control C, and then all this 3 level, label, and convert it to R3. Now, sideways bias, RSI 50. Staying between S1 and R1, failed to break above, validated. So sideways between S1 and R1. If it breaks below S1, switch for a bearish outlook. If it breaks above R1, potential for a bullish outlook, taking aim at hypothetical resistance at 448. Breaks below S1, potential support could be at 390.30. We could look at Google. Google's broken above resistance, turned to support 135.25. You've got S2 129.80, S3 122.60, RSI 52, relatively sideways bias between S1 and R1, as long as it stays in between S1 and R1. We could also add the Bollinger Bands as well to see if we are correct. Now, I would not be surprised if they're slightly converging. So, aka narrowing. Bollinger Bands, as you can see, still wide, so there's high market volatility. But this break above S1 was above the mid range, so I wouldn't be bearish on the company stock price. Instead, I'd opt for a sideways bias as long as it does not break above R1. If it continues to narrow, so implying an easing of volatility in the market, stays potentially between S1 and R1, whereas breaking above R1 could constitute for a bullish outlook. I would also like to look at UBS. Okay, jumped. 1, 2, 3. Overall, bullish outlook for UBS from a technical point of view. From a fundamental, I'm not sure as to why, but from a technical point of view, bullish. Simply look at the RSI, look at the price action. It's going very nice in an upwards fashion. You have one trend line. I wouldn't draw a second because it gapped up. If this was continuous price action, so let's say similar to this, slightly higher, came back down, moved higher, came back down, etc., etc. So there was a bit of a continuation in the chart. Then I would have drawn an upwards moving channel, trend line. Now it's overbought potentially. It's on an overbought region. RSI 83 might be Joe market correction down to S1 before moving higher, but implies that is heavy uh, bullish. There's a bullish market sentiment emerging. So let's just finish off with UBS. So last chart of the day, and we can pick up tomorrow, same time, and we'll have a look at what happened with the financial releases later on today. And if you have any questions or something in particular you would like to ask, feel free to come with questions. For now, looking at UBS, this is R1. We'll look at gold in just a moment. Have a look at it again. We'll finish with UBS and I'll backtrack to gold. R1, 31.33. Distance between S1 and S2, 121. So let's just figure out 121. 32.55, that's R2. 32.55. 31.33, 32.55, and then one more, 33.80. That could be potential R3. Note that we're simply extrapolating. We don't have historical data. As such, these are hypothetical resistance levels. If they're validated, then they may gain some weight. So let's just finish off with UBS and quickly backtrack down back to gold. So this is UBS, bullish outlook. If it breaks above R1, stays in between S1 and R1, then that would mean sideways, breaks below S1, switch for a bearish outlook. And now, for our viewer, we're going to be looking at gold. Now, gold. It's making a swing high, as you can see. Now, this week is a bit concerning, but overall, look at the RSI. As we said, it's 81. Might be an overbought territory, might be due a market correction to lower ground, potentially the old all-time high of 2,136. So if it does correct lower down to S1, wouldn't be bearish. Could be a correction. RSI could still remain around 70, so bullish tendencies, but it may be overbought. It's above 70, it's at 81, could be due a market correction. Bollinger Bands have widened extremely, implying high market volatility. So if it comes back down to S1, and I'm not talking about a rapid movement like this here, I'm talking about more a gradual decrease down to S1, you could still be bullish. You could still be bullish if it bounces off S1 and then comes back up. If the RSI stays above 60 whilst it's moving down, whilst it bounces off S1 hypothetically, then you could still be bullish. You have rising geopolitical tensions. You have the constant strikes by Houthi rebels. Then you have the tensions in the Middle East between Israel and the surrounding nations. Because, yes, that's an issue. It continues. That could funnel safe haven inflows. Then you have the issues in the Americas. Haiti, for example, you have Venezuela, you have Colombia. So those are issues as well. Geopolitical tensions that could increase the price of gold, funneling safe haven inflows. Then you have the rhetoric from China in regards to Taiwan, which could also increase geopolitical risk, although most of them appear to have not materialized. So we haven't really seen military action from Venezuela against Guyana, which may not contribute to gold's rise. But if it does happen, you could see gold increasing. If you see an intervention by the US into other countries, gold might increase. If you see an escalation of hostilities in the Middle East, gold could increase. So fundamentally, there's a high risk of global tensions. Or you could look at Azerbaijan and Armenia. That's also geopolitical risk. And then, of course, the big elephant in the room, Ukraine, Russia. Overall, you have high geopolitical risk in the world. So, from a fundamental point of view, gold could be receiving safe haven inflows as that risk increases, and should anything happen. For now, the majority of those events that I've mentioned, so potential intervention by Haiti, by the US in Haiti, or Venezuela, Guyana, Azerbaijan, Armenia, and Russia and Ukraine, the potential and current impacts appear to have been immaterial. I'd attribute potentially gold's rise to perhaps a slightly weakening US dollar. But with the risk of geopolitical tensions, I would not be surprised if it comes back down to S1, moves higher. From a technical point of view, however, might be Joe market correction. If it breaks below S1, switch to bearish. But I'd like to see the Bollinger Band come to the mid-range between S1 and S2. So for a bearish outlook, actually breaking below S2 would be a requirement in our opinion. And then, let's say, since we're saying S2, could bring S3 slightly lower, 2030. Just readjusting, just in case it breaks below S2. You have perhaps a lower S3 level that can be used in the future as well. So we've got S3. Bullish outlook, break above R1 would be sufficient, but we'll have to form a new all-time high. If it simply wicks above, stays below, not sufficient. Has to make a new all-time high, in my opinion, before it can continue moving higher, or could stay sideways between S1 and R1 if the bullish momentum is fading away. And I think with that, that should have covered your question on gold. We'll have a look at it tomorrow as well. Same time, same place. Have a wonderful day, evening, or morning, and I'll see you tomorrow.
everyone, my name is Emily. In today's video, we are going to talk about the scalping strategy. Scalping is a forex trading strategy that involves opening and closing multiple positions on one or more forex pairs over the course of a day, usually in seconds or minutes. Instead of opening one position at the start of a trend and closing it at the end, scalpers will open and close several positions over the course of a trend. Scalpers usually hold a position for a very short time, getting in and out of a trade within minutes if not seconds. The aim of scalping is to gain just a few pips at a time, looking for multiple small gains rather than fewer larger ones. Scalpers often use CFDs to trade forex pairs that are rising or falling in value. They will open a position to buy if they think the price will rise and open a position to sell if they think the price will fall. The short intervals between trades and the speed of the scalper working with price differentials enables trades to have less exposure to risk overall. In addition, if the trader is very disciplined about cutting their losses on losing trades, their risk is reduced even further. CFDs, which are leveraged products, also enable traders to open a position with a deposit called a margin. This can magnify profits but can just as easily magnify losses because your profit or loss are calculated from the full value of the position. That is why it's so important to have an appropriate risk management strategy in place no matter which scalping techniques you're using. Basically, in order for a scalper to make a significant amount of profit, a larger position size is usually required to make the trade worthwhile. But scalpers must be very careful to avoid high volatility when trading in the forex market and to have a reliable broker that offers minimal recalls. Thank you so much for watching us today, guys. Stay tuned for more educational videos. Bye-bye.
Joined, we're going to be talking about how you can set up your training journal and a couple of important pointers as well. So before we get started, as per usual, a risk warning: our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suited for everyone, and you should ensure that you understand the risk involved. A disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. Redistribution. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie. I am an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We're going to talk about how you can get the most out of your My FX book. We're going to talk about optimizing your strategy. So what's the best days, best times, best techniques as well. And also we'll be talking about the best direction, so how exactly you can do a bit of trend trading. Okay, let's get started. So what exactly is a trading journal? So it's basically like a diary, and it's a way for you to track your trading performance by recording all of your trades. So you can start a manual or an Excel sheet, or an automated trade journal. And I'll show you guys some examples in a little bit. So, importance of a trade journal. So, before we dive into the specifics, let's quickly touch on why exactly having a trade journal is crucial. So, trading journals, as we mentioned earlier, serves as your personal trading diary. So, it helps you to track your trades, analyze your performance, and ultimately improve your results over time. So, some points on why exactly you should start using a trading journal. Firstly, is to track your progress. So it basically provides insights into your performance and helps you to identify patterns in your trades. This also helps you to learn from your mistakes because you're recording your trades and understanding the reasoning behind them so that you can learn from your mistakes, avoid repeating them in the future. Okay, so this self-reflection is crucial for continuous improvement as a trader. Next is to develop discipline. So maintaining a trading journal instills discipline in your trading approach because it encourages you to stick to your trading plan and avoid impulsive decisions by holding yourself accountable for your actions. So I'm sure if any of you guys have ever traded, you will know how difficult it is to really maintain and stick to your trading plan, especially when it's not going according to your plan. Okay, so next, evaluate strategies. So you can identify which strategies are working well and which ones need adjustment or refinement. So this helps you to basically evaluate the effectiveness of your trading strategies. Manage emotions. So emotions can significantly impact trading decisions. So as I mentioned earlier, when a trade doesn't go according to your plan, um, having a trading journal basically helps you to manage those impulsive emotions by providing a structured way to review your trades in an objective manner so that it reduces the influence of fear or greed on your trading decisions. So this also helps you to set realistic goals and track your goals so that you can stay focused and motivated. Improve decision making. We kind of talked about this already. Enhance accountability. So when you're keeping a trading journal, it encourages transparency and honesty with yourself about your performance, fostering a culture of responsibility in your trading approach. Okay, so let's look at MyFX Book. So MyFX Book is a powerful tool for tracking, analyzing, and sharing your trading results. So from setting up your account to utilizing advanced features, we'll talk a bit about how to leverage MyFX Book to its fullest potential. Okay, so let's start off with what should you monitor in your journal. So typically, a trading journal should include the date and time of your trade, basically the open as well as close, the instrument being traded, so whether it's dollar yen, euro dollar, gold, WTI, position size, yeah, and then direction, whether you're going in for a buy or a sell, entry and exit points, trade result once your position is closed, profit and loss at an absolute level as a percentage of the account size, and your risk and reward. So how can your journal improve your trading? So we briefly talked about this earlier, but basically since you are able to review your trading activity over various timeframes, so daily, weekly, or monthly, it will allow you to find the right trading style, whether you are a swing trader, position trader, intraday, or scalper, and identify your strengths and weaknesses, improve your risk management, as well as have discipline. Okay, so how do you set up your trading journal? Basically, you first have to choose a format, decide on what categories you're going to be trading, followed by capturing trade details, analyze trade performance, reflect on the emotional factors, review and adapt, and maintain discipline. Okay, so these are some of the skills that you will be developing when you set up your trading journal. Performance analysis, learning and development, emotional awareness, risk management, trade planning and execution, accountability and discipline, and confidence building. Okay, so let's talk about these examples really quickly. Okay, so there are a couple of examples that we've included here about how to create a forex trading journal. So this example is in Excel. So by using an Excel spreadsheet, this example over here, so all of these are automated. So this one is manual because obviously you have to type in the data yourself, as you can see in this example here. Okay, but yeah, so this will basically look like, this is what your spreadsheet should look like. With the initial, maximum, the date, the profit and loss. Yeah. Okay. Yeah, and then for automated tradings, you can read this website as well. Okay, there are some which are free and some that you have to pay for. Okay, so the manual option is obviously free since you have to set up the table yourself. So it's really up to you and your own trading strategy. Okay, so you can go ahead and take a look at these two websites. Yeah, I'll go ahead and pop these two websites in the chat as well. So the one that I'm popping into the chat now is the manual one. Okay, and then the automated one is over here. So I won't go too in-depth into how to set up your automated trading journal because I think if you go into the website, it will tell you exactly how to do it. So yeah, let's just move on. You can also look at Forex book. Okay, yeah, so these are just some of our recommendations. Of course, it's completely up to you and your objectives when you're deciding which of these to choose from. But yeah, these are just some of our suggestions. Okay. Okay, let's move on. So let's talk a bit about optimizing your strategy. So a trading journal is not just about recording your trades, but also about analyzing them to identify patterns and areas for improvement. So let's talk a bit about some strategies for analyzing your trades and refining your approach for better results. So firstly, let's start off by talking about the best times to trade. So market volatility happens throughout the week and it varies. So we're going to talk about which days tend to have higher volatility and better trading opportunities. And we're also going to introduce economic calendars and how you can utilize them to identify when market volatility is the highest. Okay, so let's look at what exactly is an FX news calendar. So firstly, on the left, over here, we have investing.com. And on the right is forexfactory.com, which is the one that I typically prefer to use. Yeah, but they're basically about the same. They give you the dates that you're looking for. You can filter the dates. So if you're looking at this week's economic data releases, you can just filter it to look at this week or this month. And then as you can see from these little colored calendars, it also filters by low to high impact events. And it gives you the forecasted values, the previous values, as well as the actual values once the data is released. Okay, so these FX News calendars are important because it allows you to see at one glance all of the important economic data releases. And these data releases often create more volatility in the markets, so it's important to take note of them. So it shows you the key events such as the GDP, CPI, NFP, crude oil inventories, and even central banks' monetary policy meetings. Okay, so let's understand some high impact events. Firstly, we are looking at the US. So FOMC meetings are the Federal Open Market Committee, and this is the US Fed's way of communicating their view on monetary policies. So these normally come together with a Fed interest rate decision. So if the Fed is dovish, the USD is bearish, and if the Fed is hawkish, the USD is bullish. If interest rate goes up, the USD is bullish, and if interest rate goes down, the USD is bearish. Okay, next we have NFP or non-farm payroll, which measures the change in citizens that are employed from the previous month, excluding the farming industry. Unemployment rate measures the total unemployment of workforce that is seeking active employment from the previous month. Okay, and now crude oil inventory. So these measure the weekly change in the amount of crude held by US firms. So if crude inventories increase, they are inversely related to oil prices, so we can expect oil prices to drop. EIA is Energy Information Admin, and this is a short-term outlook. So it's basically the monthly forecast for the year ahead, the demand and prices across major fuel types. Okay, so some benefits of using the FX calendar. Depending on your individual trading style, it can help to plan trades and allocations for the day, week, or month ahead. And it also helps to alert the individual to upcoming important news events that may affect volatility. Let me know if you guys have any questions so far. Okay, if there are no questions, let's move on. Okay, so now we are getting into kind of the fun part. We're gonna talk about some of our favorite techniques, or some techniques that you should maybe take note of. Firstly, of course, I'm just gonna touch really quickly on this because we recently finished our Fibonacci series. So if you missed that, I think it's probably uploaded on YouTube, but if not, you can email IronFX on their website and they will probably send you the recording or give you the link. Yeah. So I'm just going to briefly talk about the checklist and what things you should look out for. Okay. So for Fibonacci, there are a couple of steps. Firstly, is the market structure clear? So you want to look for big zigzags, and we want to see, a very clear market structure, so a clear up or down. Okay. Yeah. So next, identify the recent trend. So are prices going down or up? So it's important to always follow the general trend. Next is to identify recent major swing lows and recent major swing highs. And lastly, connect the two extreme points from the highest to lowest for a downtrend and the lowest to highest for an uptrend. Okay, so let's move on. Next, which is quite important, is your take profit and stop loss levels. Okay, so for your take profit and stop loss levels, it's important to place your stop loss beyond a key confluence level, or if you look here, a key major resistance level. So in this case, we are going in for a sell since our take profit is below. So since we're going in for a sell, we will place our take profit before any levels. So in this case, it will be above any major support level. And for stop loss, we will place it beyond any major resistance level. So in this case, we're placing it above. Okay, so the reason for this is because price is attracted to such strong areas of Fibonacci confluence, or even if it's just multiple swing high levels that line up in the same area, that's also a major resistance area. So price is attracted to these areas. So if your stop loss is right before these areas instead of beyond it, you will most likely get stopped out before the market reverses. So like you can see over here, we would most likely get stopped out if we had placed a stop loss slightly below. Okay, for take profit, we typically recommend to place your take profit before a key Fibonacci confluence area, because when price reaches any significant area, there is a high chance that it won't be able to go beyond it. So instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. And this is one of the reasons why people complain that the market is being manipulated, because they might miss that take profit by 1 or 2 pips. Okay? So now let's talk about another technique, which is the trailing stop loss. So in our previous slide, we talked about, we go back. So this is kind of a fixed stop loss template. So if we talk about trailing stop loss, it's a type of stop loss that is set at a certain percentage or dollar amount away from the market price. So the idea behind a trailing stop loss is to lock in profits while giving the trade room to breathe. So basically, it means that the stop loss basically follows the market price as it moves in favor of the trade. So the example I have here is, we're talking about stocks, but the idea is pretty similar if we're talking about currency. So let's say you buy a stock at $100 and you set a trailing stop loss at $10. As the stock price rises to 110, the stop loss will follow, now at $100, since 110 minus $10. So if the stock price drops to $100, your stop loss will trigger selling your position and protecting your profits. The trailing stop loss technique can be useful for traders because it allows them to manage risk and lock in profits dynamically as the market moves. So this is different from a fixed stop loss, which is set at a specific price and does not change as the market moves. So it's important to note that a strict trailing stop loss is not a guarantee that you will exit the trade at the desired price. Market conditions such as gaps or rapid price movements can trigger a stop loss order before it reaches the desired level, leading to an unexpected exit from the trade. Therefore, it's important to use trailing stop loss in combination with a solid risk management strategy. Okay, I just realized I didn't show you guys the FX news calendar that we like to use. So let me do that now. Okay, so earlier I talked about Forex Factory being one of the FX news calendars that we like to use. So if you click on the date, so when you go into the page, it looks like this. And clicking on the date, you can select this week, apply settings, and you get the whole list of news events for this week. So if you click on this green icon, you can see that I've filtered it to only the high and medium impact events. But you can select all, you can filter out the currencies that you're looking at and the different event types, apply filter. And yeah, you can see once the actual result is released, it will update. But it will also give you the forecasted values, predicted values, forecasted as well as previous values, and the currencies as well as the different times. Okay. Okay. Also, if you weren't here for the Fibonacci webinars, you can also go onto forexalme.com over here. Okay, and you can click on trading guides. How to draw Fibonacci retracement correctly, and it gives you a pretty in-depth explanation on how to draw Fibonacci's. So we have a couple of videos for you to watch as well. What to look out for, unclear and clear market structures. Yeah, what to look out for, checklist. Yeah. So there are also different techniques for Fibonacci. So we're going, I think in this guide we go through each of them. So we have retracement up above there, as well as the different other Fibonacci techniques. So here we are combining them in order to find Fibonacci confluence levels. Yep, so feel free to go ahead and take a look. Okay, let's get back to my slides. Okay, so let's look at the different methods of trailing stop loss. So here's a summary of the different types of trailing stop loss methods that we'll be going through today. Just really briefly, firstly is the moving average indicator, followed by parabolic star, chandelier, ATR indicator, support and resistance levels, and a combination of these methods. Firstly, we'll start off with looking at the moving average. Okay, so you can see that using our MA, the trailing stop loss is triggered when price basically breaks out of it and moves above the moving average. So I think that's pretty straightforward. You can see in this example as well that it got us out before price started to increase. If we look at a trend line breakout, okay, actually this line here is kind of a trend line breakout. The only issue why we can't call it a trend line breakout is because trend lines have to have a minimum of 3 touches in order to be considered valid. And you can see in this case, we only have 2, okay, before price broke out of the trend line. So when price breaks out the trend line, that's typically a sign that price is going to move in the opposite direction, which it did. So when it moved in this downtrend, so we went in for a sell entry, and then placing this trend line here, we got out when price breaks out of the descending trend line. I think that's pretty straightforward. So let's look at parabolic SAR. So kind of the same concept. Here you see when price moves below the parabolic SAR, it's typically giving us a bearish signal. So when price begins to move above the parabolic SAR, you can see that it's moving above it. It's even broken out of the top, the upper side of the indicator. Okay, so that's a sign that trend is going to change. Okay, chandelier and ATR, same concept as well. Price is moving below, giving us a bearish signal. Once price moves above or breaks above these indicators, then both of them are triggered and our stop loss, and we get out of the trade. So I think that's pretty straightforward because all of these concepts are pretty similar just by using different indicators so that you can kind of substantiate your analysis to show that, okay, price is really breaking out over here, the trend is really changing, so I should get out of the trade. Okay. In this example, so this is just another example. In this case, we have a fixed stop loss. You can see it's a fixed stop loss at the swing high. Our sell entry is here when price breaks below this line. And also it's moving below our moving average. Here's our take profits over here. So you can see instead of just leaving our stop loss here, which you can see is really far away from where price is currently at, by using a trailing stop loss, we can get out of the trade right when price breaks above this level here. Similarly, in this case, price is breaking out of this descending trend line. Stop loss is placed slightly above. Like we mentioned earlier, stop loss should be placed beyond, take profit should be placed before. So we're going in for a sell entry and going towards a take profit over here. Okay. Okay, now let's look at using breakouts as trailing stop loss. So breakouts are usually high volatility events and price can spike up and reverse almost as quickly. So a stop loss will help you to manage risk, protect your capital, and a trailing stop loss can help you to protect your profit like we've seen in the previous slides. Okay, so let's move on to our next technique. Okay, trend trading. So here's a super simplified breakdown of how trend trading works. Firstly, you want to identify your trend. So in a price movement of a currency pair. So this is typically done by analyzing historical price charts, and an uptrend is characterized by higher highs and higher lows, while a downtrend is characterized by lower highs and lower lows. Okay, so entry points. Once you have identify a trend, the next step is to find an entry point. So in an uptrend, you might look to enter a trade when the price has retraced or pulled back slightly from its recent high. So basically, you're anticipating that the trend will continue. But in a downtrend, you might look for a retracement before the price continues its downward movement. So next we have setting stop loss and take profit levels. So to manage risk, it's crucial to set stop loss and take profit levels. So stop loss is a predetermined price at which your trade will automatically close to limit potential losses if the market moves against you. So a take profit level is where you decide to exit the trade to lock in profits before the trade potentially reverses. Number 4, riding the trend. So once you're in the trade and the trend continues, you aim to stay in the trade as long as the trend remains intact. So basically, in this situation, you would be monitoring the price movement and adjusting your stop loss and take profit levels if needed. Or you might choose to use a trailing stop loss that we just went through as well. Lastly, exiting the trade. So this typically happens when the trend reverses. But yeah, trends don't last forever, so it's important to be vigilant and not get too greedy. And remember to decide to exit your trade and take your profits where possible. Practice analysis. So I think that's pretty self-explanatory, so I won't get into that. Okay. So pullback support and resistance. So these are pretty basic trading knowledge, I suppose. But basically, a pullback support is a strong level of support which breaks out from a previous resistance level, and price is now dropping back to visit it again. So pro tip is when a pullback support lines up with a Fibonacci level, it tends to be very powerful. Pullback resistance, on the other hand, works well when it breaks a significant swing low and then starts pulling back to it. Even better if there are multiple Fibonacci levels that line up with it. So here's an example. So you can see at the red area, price tested this level 3 times with multiple swing highs in line with one another. And once price breaks the red area, it becomes a pullback support level. Then we expect price to pull back or retrace this level, which you can see from the dotted arrows. And this is an example of a pullback resistance. So you can see once price breaks the level, it becomes a pullback resistance, and we expect price to retrace and pull back to the same level, like you can see from these red arrows. Okay, now pullback resistance. Here we have a swing low, and thus a possible support level. With price passing below the swing low support, it is now a pullback resistance. Okay, so if we see in the next slide, you can see that price actually pulls back to this resistance level. And once it reaches and reverses off the pullback resistance level, it then becomes an overlap resistance level. Okay, which we will get into now. So overlap resistance occurs when price reacts off a particular level from the top and from the bottom. So the more times that it reacts off this area, the stronger the overlap area. This basically means that there are bulls and bears that are respecting that area. It's important to take note of that. Okay, so here the pro tip is that if the overlap area lines up with other elements, such as Fibonacci or graphical elements, it will make it even stronger. So that's basically what we call the confluence areas. That applies for any support and resistance level that you can find. If you can support it with your Fibonacci, your pivot points, your pivot point indicators, that would be even better. Okay, so here's an example. Basically, you can see how once price breaks below the support at 105.643, you can see how price retraced or pulled back to this resistance level and reversed off of it, making it now an overlap resistance. Okay, here's another example. So here we have a big swing high resistance level. Price surpasses this level and becomes a pullback support where we expect price to pull back to that level. So in the green areas over here, we see price retrace this level and actually bounce off perfectly. So once price bounces off the pullback support, it then becomes an overlap support. Okay, in our second example, we see two swing highs lining up. So we have a swing high resistance. So price has surpassed this level as well and making it a pullback support. Here we can expect price to retrace to that level. So you take note of the blue circles. Price bounces off this level twice, making it a strong overlap support. Okay. In this last example, we have multiple swing lows that are in line at the 33420 level. So once price breaks this level, it becomes a pullback resistance. We can see price has tested this level 3 times, 1, 2, 3 over here, making it a strong overlap resistance level. And then once price passes again, then it becomes a pullback support. And once it bounces off that level, it then becomes an overlap support. I think by now you guys have gotten it. So let's move on to our last technique. Okay, so how do you identify a trend? Okay, I briefly talked about this earlier. So how you can identify trends is obviously you can just look at the charts and you tend to be able to identify whether it's ascending or it's moving in a downtrend or whether it is ranging. But if you want to be extra certain, you can try looking for trend lines and trend channels. So what makes a valid trend line is if there are at least 3 significant touches. For an ascending trend line, the touches should be on the bottom and on, yeah, so if it's descending, then the touches should be at the top. So here's another example. Okay, you can see the touches on the bottom and here as well. For descending trend lines, it should be on the top and on the bottom, but same thing, we are looking for at least 3 significant touches. So you can see here, we have about 4, and here we have about 4 as well. Okay, so watch out for at least 3 significant touches for it to be considered a valid trend line, like over here. Okay, and you can see on the 4th touch, price is playing the reaction. Okay, so let me know if you guys think that this trend line is valid or not in the chat. Okay, someone said that it's not valid. Yep, so it is not valid because we mentioned that if it's a descending trend channel or trend line, the touch has to be on the top and not on the bottom. Okay, so if we look at drawing valid channels, the valid channels are if there are at least 4 significant touches, 2 at the top and 2 at the bottom. Okay. Over here, this is an example of a descending trend channel. So it doesn't have to be consecutive like this or like this, but just as long as there are 2 touches. Okay, now let's look at the different indicators that you can use to identify the trend. Okay, so firstly is Ichimoku cloud. So breaking down the lines, it consists of several components, and it's basically composed of 5 lines or calculations, 2 of which comprise a cloud where the difference between the 2 lines is shaded in. The lines include a 9-period average, a 26-period average, an average of those 2 averages, a 52-period average, and a lagging closing price line. So the cloud is a key part of the indicator. Okay, so let's look at breaking down the lines. So basically, when the price is below the cloud, the trend is bearish, or the signal over here is bearish. When price is above the cloud, the trend is up, or the signal is bullish. Trend signals are strengthened if the cloud is moving in the same direction as the price. So for example, during an uptrend, the top of the cloud is moving upwards, or during a downtrend, the bottom of the cloud is moving down. Okay, so let's break down the different lines. Okay, we have the Tenkan-sen or conversion line, and this is the average of the highest high and the lowest low over the past 9 periods. The Kijun-sen or baseline is the average of the highest high and lowest low over the past 26 periods. Chico's span or lagging span is the current closing price plotted 26 periods behind the current time. And Senko span A, or leading span A, is the average of the Tenkan-sen and Kijun-sen plotted 26 periods ahead of the current time, used as a leading indicator of the trend. Okay, Senko span B, or leading span B, is the average of the highest high and lowest low over the past 52 periods, plotted 26 periods ahead of the current time, used as a leading indicator of the trend. Okay, explaining the lines. So the first way to use Ichimoku is to identify trends. Basically, the Tenkan-sen and the Kijun-sen. Tenkan-sen is the one in blue, Kijun-sen is the one in red. Those are used to identify the trend of the market. So a bullish trend occurs when the Tenkan-sen is above the Kijun-sen, and a bearish trend occurs when the Tenkan-sen is below the Kijun-sen. Okay, you can also use your Ichimoku indicator to determine support and resistance levels. Okay, now the third way to use Ichimoku is for confirmation. So the Chikou span is used to confirm the signals that's generated by the other lines. And if the Chikou span is above the current price, it confirms a bullish trend. If the Chikou span is below, then it confirms a bearish trend. Okay? So Ichimoku generates buy and sell signals based on positions of the various components. So for example, a buy signal is generated when the Tenkan-sen crosses above the Kijun-sen and Senko span. And a sell signal is generated when the Tenkan-sen crosses below the Kijun-sen. Okay, so how can you effectively use this indicator? So basically, the overall trend is up when the price is above the cloud and down when the price is below the cloud. Yep, and trendless or transitioning when the price is within the cloud. Okay, so of course you can also use support and resistance, as we mentioned earlier. So yeah, so you can see when price is moving below the cloud, it is bearish. When price is moving above the cloud, then it's bullish. Within the cloud is typically transitioning. Okay, another way is price and MA cross. So if you're a beginner, this is a great way to identify moving averages of different periods to analyze price movements and generate buy or sell signals. I won't get into it, but yeah, this strategy basically captures trends and works best in trending markets. Next, we have the Golden Death Cross, which is a strategy based on the intersection of two important moving averages on a price chart. Okay, so I'm not going to explain how the indicator works, but basically, when you see a golden cross, it's a bullish signal. When you see a death cross, then it's a bearish signal. Okay, channels as well. Can see when price hits the sides of the channel, that's typically a sign that price is reversing off of the channel. Okay, so when you are deciding which settings to use for your moving averages, try and make sure that it touches the bottom of the bottom or the top of the price as much as possible. Same for natural moving averages. And a double break is basically when price breaks below the moving average as well as your trend channel. So basically, as I mentioned earlier, when you have an analysis, you want to try and make sure that you use different indicators to support that analysis. Okay? Yep, so that's what we call confluence. You can see in this case, we are using a trend channel, Ichimoku, as well as moving average, as well as your death cross. Okay, you can see we see this price moving upwards. Okay, so to wrap things up, we'll quickly go through the disadvantages of trend trading. So basically, it can give you false signals, late entries, some choppiness as well, whipsaw trades, which basically means that traders enter and exit positions quickly due to volatile price movements, which can result in losses. Limited profits in ranging markets, and it might require timely decision making. And lastly, noisy price data. So to overcome it, you want to make sure that you have all of these in check. And how you can make sure these are in check is by basically making sure that you use a trading journal so that you can track your trades, track your strategies to see what works and what doesn't. Okay, and this is just to show you guys what an unclear market structure looks like on a 15-minute time frame. You can see it's pretty messy. There's no clear price movements. But when we change to 1 hour, you can see it's pretty clear. Okay, so yeah, so this is just a kind of a rule of thumb to live by. So if the clearer the swing low, the clearer the swing high, the clearer the trend between these 2 points, the more accurate your analysis will be. Okay, that brings us to the end of my slides. Thank you guys so much for joining me today. I hope you guys found this helpful. And yeah, have a great rest of your week, and I'll see you guys next week. Bye, everyone. Thanks, everyone. Bye.